Why do mortgage rates jump? Why does your credit card APR suddenly change? It all starts with one number, the federal funds rate. The federal funds rate is the lowest interest rate in the entire U.S. financial system. It's the rate banks charge each other for overnight loans to make sure they have enough reserves. Because these loans are extremely short-term and low risk, this rate becomes the base price of money in America. Since banks are lending to each other inside the safest part of the financial system, the risk is tiny. That's why it's cheaper than any mortgage, auto loan, business loan, or credit card. Those consumer rates are built on top of the federal funds rate, like stacking bricks on a foundation. When inflation is rising too fast, the Fed raises the rate. Borrowing becomes more expensive, spending slows, and inflation cools. When the economy weakens or unemployment rises, the Fed cuts the rate to make money cheaper and encourage lending and investment. The Fed studies inflation data, job numbers, consumer spending, wage growth, and financial stability. Their goal is simple: keep inflation low, keep employment strong, and keep the financial system stable. A higher Fed rate means higher mortgage payments, higher credit card APRs, and more expensive business loans. A lower rate means cheaper borrowing. But if it stays too low for too long, inflation can surge. The federal funds rate shapes the entire economy, and it affects your wallet more than you think. Comment below for any questions, like and subscribe if you find this video useful.